Okay, in this video, I'm going to be talking about ICT institutional price levels. Okay, so I've actually made a video on this in the past, but for any of those of you who have not seen it, we're going to be covering it again in this video. So put simply, the institutional price levels that you need to be aware of, because institutional price levels, they serve as support and resistance. And I don't think you should just use institutional levels of support resistance as like standalone. I think without a doubt, the best way to use them is in conjunction with other concepts, like having a firm understanding of market structure, using other ICT concepts like the order block, the fair value gap. You got to have that bias. You got to know where the drawn liquidity is. All of that is still important, sure. And you can use these institutional price levels to nail down your entries better, to have more high probability entry points. So for example, the institutional price levels are the 00, the 20, the 50, and the 80. So right here, for example, we have a 50 institutional price level. What I'm going to do is I'm going to note that there's 50. See that? There is the 50 institutional price level right there. Where's the next one after that that's going to serve as, what's the next level after that? It is the 80. See that right there? So you got the 80 right there. You're not counting the very last number. You see that very last number? You're not counting that. You're just counting right there. Boom, 80. So that's another institutional price level. So that is an institutional price level of resistance, because we're below that area at the moment. So it's serving as resistance. Okay. What's next? The 00. So see, we move up. There's 80. Let's move up. There's 90, 00 right there. You're going to note that. That is a level of resistance. And you can see it actually respected that level of resistance right here earlier. See that? How it popped up into it, it rejected. Popped up into it, rejected. That's the level of resistance up there. And then where's the next one? So we're moving up. There's 10. It's 10 an institutional price level. It's not. Let's move up, and boom, 20 right there. There's your next one after that. These are your institutional price levels, all right there. Institutional price levels. So how can we use the institutional price levels? Because it's support resistance. That's what it is. It serves as support resistance. A good way to use the institutional price levels is as a means of whenever you get your entry in. So you could use the institutional price levels for a higher probability entry point. So for example, let's say you want to enter in a discount marketplace, because I know a lot of you that do trade SMC, you're familiar with premium and discount pricing. You're familiar with the optimal trade entry, correct? So let's say you're already using that for your entry, getting your entry point. But now let's say you add in the institutional price level in there as well. Just by doing that, you make it higher probability. Just by doing that one simple thing, you make it higher probability. So for example, we have this shift in market structure right here. We had this big surge up. We broke this swing high, fair value gap confirmation. We got the hold down here. We took liquidity. That's a high probability shift in market structure. And I want you to notice how you have that 50 institutional price level in a discount marketplace. Take your Fibonacci from the high to the low and measure that price range. Notice how that 50 institutional price level, notice how that is in a discount marketplace. Notice how it's beneath 50% equilibrium. Whenever you have that criteria where you have a shift in market structure, a high probability shift in market structure like this, and you have that institutional price level in a discount marketplace, and in this example, you even got it inside of the fair value gap, which takes it to an entirely different level. The sensitivity that you'll see whenever you have that criteria, it's a very sensitive price point. Just like whenever we have old highs or lows that are broken, that are inside of the fair value gap, are sensitive price points. It's the same deal with institutional price levels. Whenever you have it inside the fair value gap, sensitive price point. But the key thing to take away here is it's in a discount. It's in a discount within that price range, making it a established level of support. And whenever you have it like that, whenever you have that institutional price level in a discount where you want to get your entry, you'd have your order set at that 50 level. Or if you're shorting, then it would be in a premium. That is where you want to get your entry for the very best place. It does make it higher probability. It comes down into it, the 50 level, it taps into the imbalance, it respects it, and then it moves higher and takes out that upper buy side. We come up to the 80 level. We're cracking it at the moment, as you can see. So we cracked the 80 level, and that's that. Okay, so now I went to the 1 hour chart to kind of clean it up a little bit more. So here was that original push. We got the respect of that level. Then it came down and swept the sell side, and then it bounced back up off that level. Now, right here, we come up. Look at my cursor. We come up and we break this 80 institutional price level. We break that level of resistance. We like popped our head above that level right here, but it didn't clear that level. It just like popped its head above it and then it pulled back. That's not a clean break of that level. This move right here was better. Why was it better? So right here, look at my cursor again. We're moving up. we break above that level, and then we put in a swing low level right here. So we have untapped sales, we have sell side liquidity beneath that level. And another way to measure discount and premium is whenever you take out a swing point. So we took out this 1 hour swing low level. What does that mean? That means you enter a discount marketplace at that point. The second you take out that swing point, you enter a discount marketplace. So you take out that swing, discount marketplace, and guess what? The 80 institutional price levels in a discount marketplace. The market structure is confirmed bullish at this point because we had that shift earlier. So the market structure confirmed bullish. We're taking out sell side liquidity, so we're entering a discount marketplace, and we have that 80 institutional price level in a discount marketplace. Just like down here where we had it below 50% equilibrium with that price range, that's one way to go about doing it. But up here, we have a new institutional price level being the 80 level that has been broken. Resistance when broken becomes support going forward, because remember, these institutional price levels, they serve as support and resistance. Just like you have old highs and old lows, you treat this the same way. You have an 80 institutional price level, it's broken. Puts in a swing low, takes out the swing low, we enter a discount marketplace. It's cheap. It comes down, it tests the 80 level where you could enter looking for that continuation, because the 80 institutional level, the 80 institutional price level is a level of support. And then it respects that level and it comes up. It attacks the highs, and then it comes up into that 20 institutional price level where it eventually breaks it, as you can see. Yep, so that about covers it. So again, institutional price levels are 0, 20, 50, 80. They serve as support and resistance. So whenever you get like a shift in market structure, it's always best if you have the institutional price level in a discount marketplace. That's if you're buying. If you're shorting, it'll just be in a premium. And it's a very solid level of support and resistance. But also on the other side of the coin, whenever you take out like an old swing point or an old high, that also counts as a discount and premium. And again, you'll see that level respected at that point as well. Many times, not always, nothing's 100% in the market, but it does make the plays higher probability when you have those institutional price levels.